Hello investors, thank you so much for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about Alcoa. So Alcoa is very well positioned to benefit from several storms that are happening right now. So there's the Russian invasion of Ukraine that's having sanctions against Russia. This has led to price increases in Europe, and this impacts the profitability of the companies in Europe. So they're having to raise the prices of aluminium, and this is having a knock-on effect in for Alcoa as a whole. So we're going to go through all that. We're going to talk about why this is an interesting setup for investors right now. Ultimately, we're talking about a business, Alcoa, that is seeing its bottom line profitability meaningfully increase over the next 12 months, but valuations, even though there's been a slight pop of late in the last, let's say, several weeks, I don't think that this is anywhere near the end of the story. So, I mean, let's just get into it, right? So, revenue growth rates have been steadily improving, and Q4 they were up 40% year over year. This has been like the fastest growth of the company for a while. But I think that even as we come up against easier comps with into the first start of Q1 2022, I think that overall there's just so many different dynamics that are working favorably for Alcoa. So I'm just going to jump in and discuss some of those, okay? So in the last several days, prices of aluminium have been increasing meaningfully year over year, and the futures are pointing to approximately 3.8k. So this means that in the last 20 days, we've seen the futures price increase by approximately 20% in the last month or so. So the price of aluminium continues to rapidly increase in the last several days. But at the same time, global stocks consumption, the amount of inventories is at 42 days. So that means that there is low inventory, prices are high. This 42 days is a number not seen in the past decade. So in the past decade, it has been meaningfully above 42 days. In fact, listening to the conference call from Alcoa from a few days ago, they're saying that this hasn't been a number seen since before the financial crisis. So you have a lot of constraint, you have inventories being down, you have prices really soaring. So it's just an incredible storm for Alcoa. Positive for them, of course. The other thing here, so the amount of supply coming on board has really flattened out in the last, let's say, 5 years or so, and this has been predominantly because in the earlier on in the decade, in the 2010s onwards, China was very aggressive. They were kind of putting a lot of supply online, but now China's saying to themselves, I don't really want to pollute my country. Why should I bother? So they kind of limited the supply coming on board, and if you have less supply and you have demand coming up, it's just a very good position overall for Alcoa. Keep in mind as well that to bring new supply on board takes approximately 2 years or so. So inventory is down, supply takes about 2 years to come up, prices are going through the roof. So altogether, I think that this is something that is reasonably quite favorable. I mean, you never know everything in investing, and no one could have really predicted how this would have all impacted the European players. But you can see here, there's been an energy crisis in Europe in the past, 6 months or so, and for the European players, the cost for them to make the aluminium is really just going up and up and up. They're trying, of course, to increase the prices to offset some of that, but in comparison with Alcoa, the price of energy prices haven't really meaningfully come up. So you have a very strong relative competitive advantage compared to your peers. So price is high, cost base hasn't really dramatically changed, so you get in a lot more operating leverage, which will ultimately percolate down to the bottom line profitability. Next, I think it's quite interesting just to kind of take a step back and look at this, right? I think that let's just look at the balance sheet, right? They have 1.8 billion of cash and approximately the same amount of debt. So it's a net neutral position on the balance sheet, okay? The cash and the debt are roughly equal. But compare that to Q4 of last year. In Q4 of last year, they had a net debt position of 800 million. So not only is the balance sheet meaningfully better, the setup from here, going over the next 12 months, you have prices higher, better balance sheet, better operating leverage, stronger free cash flow. I think that, it's a good setup for investors. The other thing that I think is worthwhile talking about is that the free cash flow for Q4 21 was 410 million versus negative 75 million in the same period a year ago. So that's again what I've been reflecting. So is the free cash flow generation is really coming up very, very strongly here, and there is no reason for this to meaningfully revert in the next year. I mean, for the next year, this looks really reasonably strong. You have, as I already described, you have a much better balance sheet. You have favorable outlook, macroeconomics factors helping facilitate all this, and ultimately you are in a position that you are. So yeah, sorry, got caught in my thoughts slightly there. So you're looking at a business that is priced at approximately, let's say, 11 times this year's 2022's EPS numbers. But I mean, this is a guess. Nobody has any idea really how this is going to unfold. In the same way that nobody could have really foreseen this whole Russia situation. You also have to kind of offset that with some adjustments on the asset retirement obligations, pension liabilities. So there, that number is really kind of fudgeable. But just for us to start discussing somewhere, it's priced at approximately 11 times this year's EPS. For a business that appears to be growing possibly around 15% on the top line, paying 11 times EPS, I don't think it's very expensive. I think that this is, there's a lot of uncertainty here. There's a lot of question marks. How quickly things calm down with Ukraine, with Russia. There's a lot of macro factors here. But I'm inclined to believe that the risk-reward profile here looks relatively strong. You never really know how things are going to play out, right? So you're always trying to buy into things with margin of safety, and you just hope that the setup, the balance sheet, the free cash flow generation is enough to provide you with that upside potential. So you're looking for a favorable risk reward where the downside isn't that significant and the upside could be, a 2x in a reasonable amount of time. So if you want to find out what kind of names I'm looking at right now, don't forget to check out my marketplace. It's called Deep Value Returns. I highlight for you high quality, actionable investment insights. Thank you so much for listening, and I'll see you next time. Bye-bye.